In some market opinion going as well, and Anup Maheshwari, who's the head of equities at DSP BlackRock investment managers, he believes that there is still plenty of juice in the large cap stocks. Meanwhile, the president at DSP BlackRock, Naganath, is of the view that the correction in the market, if at all it happens, will be a result of geopolitical factors and not the domestic factors.
Corporate earnings growth, which has been sluggish over the last 2 or 3 years, looks like it's going to accelerate quite nicely in the next 24 to 36 months. And that will normally tend to provide a strong support for equity prices. So I think even if there are corrections along the way, and I think corrections will come because of international factors, geopolitical tensions, faster pace of rate hikes by the Federal Reserve, sluggish growth elsewhere that causes a bit of risk aversion in global equities. Domestically, I don't see any factors that will contribute to a correction, because I think the mood is turning very optimistic with the growth outlook for the economy and for the corporate sector. Within the market, one would argue perhaps that the mid-cap, small-cap valuations are looking a little stretched relative to historical valuations, and therefore large caps at this point in time probably look a little more attractive in terms of valuations relative to mid and small cap. But the outlook for the medium term, I think, is looking quite optimistic.
Also, sir, we are halfway into the earnings season. Looking at the earnings, the numbers which we've seen till now, are they according to your expectations? And also, more importantly, have you seen signs of earnings revival?
I think earnings are reviving. Again, if you take a very sort of overall view, the numbers may not necessarily reflect improvement in one sector versus the others, etc. But like I said earlier, I think overall the corporate earnings growth looks to be on the upward, on an upward trajectory. If the earnings were growing in single digits, say for the last 2 or 3 years, I think in fiscal 18, ending in March 18, one should expect somewhere in the range of about 15% earnings growth. And with that momentum continuing, I think pretty much for fiscal 19 as well.
So one trend which we've seen unfolding in the markets is that the two obvious leaders, IT and pharma, haven't given really impressive returns to the investors. Pharma, of course, is facing difficulties with US FDA issues, price caps and so on and so forth. IT, of course, H1B visa issues. In that context, where do you see leadership emerging in the market?
Well, I think, once we see the capex cycle picking up, it's quite possible that in the next 12 to 24 months, the entire segment of the market that is focused on benefiting from such an improvement in the capex cycle should benefit. So engineering, infrastructure, etc., etc. I think, cyclicals also could benefit, as we see more investments in capex. The consumer sector seems to be rebounding back quite nicely based upon the results of some of the FMCG companies recently. So I think even the bank sector, which is a big weightage in any bellwether index, once we have the NPA issue sorted out, I think, that should continue to perform quite well.
If you look at the broader markets, the mid-cap space has performed really well, giving year-to-date returns of about 35-36% to investors. Do you think this momentum will continue in this particular space, or do you think we've reached a point where investors really need to start questioning the valuations of the space?
Yeah, so as I've mentioned, as you go down the market cap chain, valuations have become higher. And in the last 3 years, we've seen some incredible returns from that particular part of the market. Now we've seen historically, when you get outsized returns in one period of time, it's going to balance somewhere else. And therefore, the ability to returns to continue to be outsized for a long period of time are quite rare. So we are a bit concerned, as I said earlier, on valuations as you go down the market cap chain, and we're just cautioning investors that, listen, don't look back at the last 3 years' returns or even the year-to-date returns in smaller companies and extrapolate them in terms of your return expectations.
So also, what's the view that you're forming on the housing sector? Because that is one space where a lot of activity is happening, be it in the form of a real estate regulator coming into force. The government has been pushing for affordable housing. The dynamics of the sector are clearly changing. What's the view that as a fund DSP BlackRock is forming on the housing sector?
Yeah, we're very positive on housing long term. I think there's absolutely no doubt in our minds that volumes will pick up substantially through these various initiatives by the government. And as interest rates also come off, I think it's very, very conducive. It's the perfect combination. Prices of real estate have stabilized and are down. Interest rates are down. So the affordability of housing has moved up dramatically, and therefore we see more and more people coming into the main line in terms of buying housing. So we expect volumes to pick up, which is very good for housing finance companies particularly, and eventually for real estate companies as well, because the market's going to get much more organized.